Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
So our focus today is CORZ, CORZ, and just the brutal repricing that happened after the very public termination of that CoreWeave merger speculation. The M&A floor is gone, and the market's reaction was, well, it was immediate and forceful.
It was. That definitive hard no from CoreWeave CEO Michael Intertrader, it's just forced an instant valuation collapse. I mean, we saw the stock drop, roughly 7 to 8% on December 15th? It slid hard from that 1650 range down into the low 15s, finally settling around 1528 on some really heavy volume.
Exactly. And now the stock has to trade purely on its own standalone merit. So the central question for us, I think, is this. Does the current valuation reflect a justified market correction that's driven by real operational risk, or is this an extreme undervaluation of some, unique, non-replicable AI-ready assets? I'm firmly arguing for the latter. The standalone asset value is fundamentally strong, and I think it's just being severely undervalued by a market that's fixated on short-term trading. CORZ is being mispriced.
And I maintain that the intense selling pressure, the high-velocity moves we saw, and the concerning market microstructure, all of it confirms this correction is necessary, it's rational, and frankly, it might not even be over yet. The market is pricing in risk, not opportunity.
Okay, but I think the core mistake the market is making right now, and it's a huge one, is that it is completely failing to look past the Bitcoin miner label. CORZ is rapidly transitioning into a critical AI infrastructure provider. Let's just look at the foundational evidence. When shareholders rejected that initial CoreWeave deal, they weren't just rejecting an offer. They were actively signaling that the scarcity of core scientific secured gigawatt-scale power interconnects was valued higher than the certainty of that all-stock swap. And that swap, remember, implied a $9 billion equity value. That action was an asset defense.
I see why you emphasize that shareholder action. I do. But it was a gamble that now has to be paid for with execution.
And the execution is happening. The operational pivot is already proving successful. We're talking about high-density colocation, HDC, which for anyone listening just means hosting these massive power-hungry AI servers instead of the old Bitcoin mining rigs. HDC revenue grew a phenomenal 45.6% year-over-year in Q3 2025. That is the engine of the future. And what's more, the institutions, they clearly see this value gap. The consensus analyst rating is still a buy, with an average price target of, $26.82? That implies over 60% upside from where we are now. That spread is all about the long-term scarcity of the physical assets.
That's a compelling point, but let me give you a very different perspective based on, the financial reality. The stock's valuation is being correctly compressed by structural market forces and, frankly, inescapable operational risk, regardless of the long-term HDC promise. We have to acknowledge the deep skepticism that's reflected in the microstructure. I mean, look, short interest is massive, 27.78% of the float. That's almost 60 million shares. This is a near consensus bet by sophisticated professionals that the stock is wildly overvalued without that merger buffer. And more critically, the company is facing acute financial pain right now. The Q3 2025 financials, they show a devastating net loss of $146.7 million, a negative adjusted EBITDA of negative $2.4 million. And that AI build-out, it is brutally capital intensive. CapEx was $244.5 million in Q3, and here's the crucial dependency. $196.4 million of that funding came directly from CoreWeave itself. So the company's growth is fundamentally reliant on a complex relationship with the very counterparty that explicitly refused to buy it. The market is pricing in the extreme risk of that dependency. It's not buying the thesis that the cash burn is sustainable.
Well, that tension you just described between the market skepticism and the asset value, it brings us right to the dynamics of the recent price action. You brought up market microstructure. Let's drill down into the plumbing of what actually happened on December 15th.
I come at it from a different way. I don't buy that the exceptionally high off-exchange activity is, benign. For listeners who might not be tracking every tick, when we talk about microstructure, we're talking about the technical mechanisms of trading. where and how orders get filled. We saw exceptionally high off-exchange internalization. Over 40% of the daily volume on December 15th was traded off the lit exchange in so-called dark pools. This high ratio, especially when it comes with a steep price strap, is a very short-term bearish signal. Okay, the arbitrage funds that bought up massive blocks of shares hoping for that CoreWeave deal, they're now forced to execute stealth exits. And they use these dark pools to facilitate that large block selling with minimal slippage. It's the sound of institutional whales changing places underwater. This process bypasses the public order book, it lets them liquidate efficiently, but it exerts this hidden, consistent, depressing force on the official price you see on the NASDAQ. It enables an organized institutional retreat.
That's an interesting point, though. I would frame it differently. I appreciate the nuance on dark pools, but I think you're confusing cause and effect. The liquidity isn't simply facilitating the pain, it is preventing a catastrophic collapse. Yes, dark pool volume was around 40% that day, but I'd argue this high internalization is actually a structural necessity that acts as a dampener on volatility.
How so?
Think about it. Arbitrage funds were holding tens of millions of shares. If they had dumped all of that supply directly onto the public exchange after the news broke, the crash could have been much, much deeper than the 7 or 8% we saw. The fact that market makers like Citadel, which has a 5.5% stake specifically for providing liquidity, stepped in to absorb that pressure off exchange. Well, to me that suggests new long-term infrastructure funds are actually entering, providing a buffer. The high dark pool ratio, in this context, it's a sign that the market has the deep liquidity needed to manage a massive institutional rotation without a total collapse. It signals stability, not danger.
I acknowledge the idea that liquidity serves as a buffer, but buffer or not, the dominant flow was definitively selling pressure. If you have a flood of water, a larger pipe just means the flood happens faster. That high volume enabled more efficient, organized selling, which still pressures the price downward to critical support levels like that psychological floor around 1442. The market isn't stabilizing, it's finding its new floor under all that institutional pressure.
But that pressure, fueled by the arbitrage exits, it runs directly into a structural trap created by the existing short interest. And this is the heart of the short squeeze thesis, which is why the stock remains a powder keg. We have to translate these structural figures for the investor.
Let's do that.
Okay, so we have 27.78% of the float short. That is a staggering amount of money betting against this company. Crucially, the days to cover metric is at 6.68. So this metric tells you how many average trading days it would take for all those shorts to buy back their shares. 6.5 days is high. It means the door to exit the short trade is incredibly small. Any positive operational news, a new HDC client, an alternative financing source, it creates massive systemic risk for short sellers because they cannot all exit at once without spiking the price. Retail sentiment, especially on platforms like Wall Street Bets, is laser-focused on this. A sustained break above that 1650 resistance could easily trigger panic buying.
I'm sorry, but I just don't buy that the squeeze narrative is the primary driver here. This framing confuses symptoms with the disease. The shorts aren't not just betting on a simple squeeze. They are rational actors betting on the necessity of equity dilution to fund this capital-intensive HDC expansion.
But
look, shorts are betting on the math. They see that massive $244.5 million capex burn in Q3, and they realize management is going to have to issue more stock to pay for future expansion, especially now that the CoreWeave deal is gone. It's like funding a skyscraper before any tenants move in. Management must secure future financing, and until they're profitable, forcing the stock back toward a commoditized Bitcoin miner valuation is a rational bet. The short position is a direct function of dilution risk, not simple market manipulation.
But that dilution risk is predicated entirely on the assumption that management has no other tools, which brings us back to the financial history here. That history proves they are highly adept at complex financial maneuvering.
That's a compelling argument, but have you considered the legacy of that corporate history on investor confidence? The complexity itself is a tangible risk. I mean, the retail investor confusion about reverse splits and the stock's legitimacy is profound. And while there were no standard reverse splits,
The sheer complexity of the January 2024 Chapter 11 emergence, which involved canceling all the old equity, issuing new stock, plus warrants, and the de-SPAC merger before that, it created these visual anomalies in the chart history.
Right.
This has fostered a negative retail sentiment that management is somehow incompetent or operating in bad faith, which in turn just destabilizes the stock's defense at these psychological support levels. The complexity created a legacy of distrust that just overhangs the market.
I would strongly reframe that corporate history. To criticize the complexity is to fundamentally ignore the success of the outcome. The Chapter 11 emergence was functionally a successful hard reset. Let's be clear what that meant. The company converted hundreds of millions of debt into equity, effectively slashing the debt load by $400 million. This was essential financial surgery. This successful deleveraging is the only reason the company was stable, nimble, and attractive enough to receive a $9 billion acquisition offer in the first place. This history proves the competence of the leadership to perform sophisticated financial engineering. To criticize the process is to ignore the foundational stability that created this whole HDC opportunity.
The successful deleveraging is undeniable. It cleans the balance sheet, but it doesn't solve the current execution problem. The balance sheet is cleaner, sure, but the income statement is bleeding red ink. That $146.7 million net loss in Q3 can't be ignored. That puts the focus squarely back on execution risk. If you can't get profitable clients into those facilities fast enough, the historical success becomes irrelevant.
Execution is the key word, yes, but the assets are non-replicable. They are the moat. Finding locations with secured, affordable power at gigawatt scale is astronomically difficult now because of grid constraints. The physical assets that shareholders chose to defend, they are the very definition of scarcity.
But a valuable moat doesn't stop the company from starving inside the castle walls if the transition takes too long and they run out of capital. That's the dilution risk the shorts are pricing in.
So where does this leave an investor? I fully acknowledge the near-term volatility, the painful Q3 cash flow, and the need for flawless execution. However, I maintain that the long-term, non-replicable nature of this power infrastructure, the core asset that shareholders defended, is deeply undervalued at $15.28. The risk-reward profile here heavily favors the patient, long-term investor betting on execution. The analyst target of $26.82 signals that the institutional street still sees the immense value.
And I acknowledge the compelling growth in HDC revenue. That 45.6% increase is an undeniable bullish signal for the future, but I can't ignore the immediate reality. The transition is financially painful, with overall Q3 revenue contracting 15%. And the market microstructure risks, the high short interest, the price fragility we saw in the dark pools will continue to overshadow the long-term thesis. Until management can definitively prove they can generate positive cash flow faster than they burn capital, the stock will remain a battleground dominated by structural short bets pricing in necessary dilution.
This discussion really just highlights the profound conflict between short-term financial mechanics and long-term strategic asset value.
Exactly. We've explored the tension between the optionality embedded in CORZ Scientific's physical infrastructure and the immediate execution risk inherent in its complex capital structure and ongoing transition.
And the material provides robust evidence for both perspectives. It emphasizes the short-term fragility caused by the CoreWeave termination, but also the profound long-term potential of those underlying defended assets. Weighing the risk of further dilution against the reward of owning scarce power capacity is, well, that's the determination left to the individual investor.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.